Let's get more on the markets now from David Kudla. He is Mainstay Capital Management Chief Investment Strategist. David, good to speak with you. From where you sit, what is your read of the sell-off today? Does it reflect a reassessment, a fundamental reassessment of how hard a coronavirus outbreak would hit the United States, or is it just the uncertainty is something investors are finally trying to price in, whereas before they were only pricing in what they knew?
Yeah, I think it's a follow-through to the sell-off on Monday and the sell-off we've had the past few days. You know, I think the argument could be made that earlier in February, the markets may have been underreacting to the coronavirus spread. But what we saw through the weekend was that coronavirus has now made it to the European continent, that Italy is the epicenter of coronavirus in Europe, and that raised concerns. And it's really the concern of the unknown, the renewed uncertainty about coronavirus spreading. The markets hate uncertainty, so the selling accelerated on Monday, and we saw that follow through to today. So the question is that selling getting a bit overdone, or is it a more appropriate response to, you know, how far coronavirus has spread and that eventual impact to the economy?
One question, though, because the uncertainty is not anything different from what we had last week when the market hit record highs. I mean, we're dealing with uncertainty all the way through. What makes it so that investors are less willing to see the glass as half full as opposed to half empty this time around?
Well, I think that it is, you know, we saw that, I think that investors believe that coronavirus was mostly contained in China, or believe that it was contained to the Asian continent, and now we've seen it pop up in the Middle East and in Europe, and we've seen now the talk just in the last segment about what it would mean to battle coronavirus in the U.S. and that uncertainty and that fear in investors' minds has created more selling in the markets. And as we continue to see that selling beget selling, and I think we see some more follow through here. We've seen recovery though here later, as we've gotten to the later hours of the trading session here.
So, David, I mean, is this something then that I guess the market just kind of has to work its way through on its own? Or is this the type of thing where we should expect some sort of policy response, whether it's from the Fed and monetary policy or from the government in terms of some sort of fiscal measure?
I think that, you know, we heard former Federal Reserve President Coach Lakata had proposed that the Fed should cut interest rates now, should cut the Fed funds rate now. I don't think we'll see something soon, but we've seen the Fed funds rate futures pricing in a Fed rate cut sooner and sooner this year, as early as the June meeting. And that's probably likely that we will see a response. That doesn't cure coronavirus, but it does give underlying support in investors' minds and underlying support to a weakening economy that can be caused by the impacts of coronavirus, even if it doesn't spread here to the U.S. We know that it impacts the global supply chain. It will have some impact on the U.S. economy and certainly on the global economy. We already know that. Mm-hmm. So I expect a Fed response, and a response sooner rather than later. Mm.
When it comes to rates, we're looking at a 10-year yield that fell to a new record low, 1.305%, currently at about 1.238%. A 30-year yield also at new lows. How much more can they fall, David?
I think they can fall quite a bit further. I don't think it's unrealistic that we could see the 10-year move to 1% this year and a 30-year down to 1.5%. We were already in an interest rate environment this year where we saw rates falling. We've been in zero coupon bonds and have enjoyed that duration play. That's accelerated a lot here recently, been a good hedge for portfolios and those investors that have held long-term bonds in their portfolios, both for a hedge and for that play.
To risk assets, where do you go? Where's safety? Where's the hedge?
Yeah, that's what I'd like to reaffirm, we don't think this is the makings of a bear market. We think that investors, depending on their tolerance for risk, should stay invested, but have those hedges in place. And those two hedges are gold and long-term bonds. Those two hedges have worked very well and will continue to. We have gold and long-term bonds in our most aggressive growth portfolios, but we're still staying with our tech stocks and our large cap growth plays because we think that longer term and even yet this year, those companies are going to continue to do well, those secular growth stories. We're seeing tech stocks do a little bit better in the recovery late today. And those cyclical stocks and some of those plays, industrials, energy, those travel, leisure, transportation, those stocks are going to be more affected by the impacts of coronavirus. The economically cyclical stocks are going to be more impacted by coronavirus and impacts to the economy. So we think those secular growth stories are where you want to be. So we still like technology, information technology, large cap stocks that also are beneficiaries of Fed liquidity and central bank liquidity. Stimulus coming into the markets is going to the large cap, most liquid stocks that will, in the inevitable other side of this, when the markets rebound, do quite well.
All right, David Kudla. David, we got to leave it there. Our thanks to you, David Kudla, Mainstay Capital Management.